Nobel Prize-winning economist Harry Markowitz called diversification the only free lunch in investing. It can reduce your risk without necessarily reducing your returns. Here's how to do it right. Welcome to AutoTube Finance. Today we're diving deep into how to build a diversified portfolio. Diversification means spreading your investments across different asset classes, sectors, and geographic regions so that a loss in any single area doesn't devastate your entire portfolio. When one investment zigs, another might zag, smoothing out your overall returns. Consider this. If you had invested everything in a single tech stock in 2000, you might have lost 80% of your money when the dot-com bubble burst. But a diversified portfolio blending stocks, bonds, and international investments would have weathered that storm with much smaller losses and recovered much faster. Diversification doesn't eliminate risk, but it does help you avoid catastrophic losses from putting all your eggs in one basket. A well-diversified portfolio typically includes four main asset classes. First, U.S. stocks for domestic growth, ideally through a total market index fund that covers large, mid, and small-cap companies. Second, international stocks for global exposure, covering both developed markets like Europe and Japan and emerging markets like China and India. Third, bonds for stability and income, including government and corporate bonds of varying maturities. Fourth, consider alternative assets like real estate investment trusts, commodities, or treasury inflation-protected securities for additional diversification. The specific allocation depends on your age, risk tolerance, financial goals, and time horizon. A popular starting framework is the age-based allocation. Subtract your age from 110 to get your stock percentage, then split the remainder into bonds. A 30-year-old would have roughly 80% in stocks split between U.S. and international, and 20% in bonds. Rebalance your portfolio at least once a year. If stocks have outperformed and now make up 85% of your portfolio, sell some stocks and buy bonds to get back to your target. This forces you to buy low and sell high systematically. Use tax-advantaged accounts like 401, QIs, and Roth IRAs first, then taxable accounts. And keep it simple. You can build a perfectly diversified portfolio with just 3 or 4 low-cost index funds. A diversified portfolio is your best defense against market uncertainty. Subscribe and hit that bell icon for more practical investment strategies every day.